Hey, it's Carol and Tim.
And we have something new and exciting for you.
Everything you love about Bloomberg Radio is now in your car.
The new Bloomberg Business app, now featuring Apple CarPlay and Android Auto.
Listen to your favorite Bloomberg radio stations anytime.
Plus, every Bloomberg podcast, the latest news and more, all at the click of a button.
It's free and simple to use. Just download the Bloomberg Business app on your smartphone and connect your phone to your car.
The Bloomberg Business app, now with Apple CarPlay and Android Auto features. Download it free in the Apple App Store or on Google Play.
Presented by our sponsor, Interactive Brokers.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, folks, we're going to stay with the retail theme right now. We did mention a tale of two retail stocks today. Walmart stock down the most in more than a year as the retailer struck a concerned tone on the outlook for U.S. shoppers after signs of weakness in the second half of October. And then you had Walmart's CFO coming out saying a sharper fall off in sales during the last 2 weeks of the fiscal third quarter, which ended, Tim, October 31st.
Yeah, this was really interesting. November, though, off to a good start, thanks in part to promotions and holiday shopping. Higher interest rates and student loan repayments, though, weighing on demand. It's interesting when you think about it, because that also coincides with the period where we've seen the data come in a lot softer, Carol, sort of the beginning of the month.
Stay tuned.
Yeah.
Although people tend to, when they're going to spend, they'll spend for the holidays because it comes once a year. So we'll see, I guess. Let's get to it, though. We want to talk a little bit about what's going on, a little bit more on retail. Jen Bartashus is Senior Retail Staples and Packaged Food Analyst. She is joining us on Zoom from BI headquarters in Princeton, New Jersey. Jen, hey, good to be back talking with you again. Let's start with Walmart. I feel like when they say something or we get some news out of them, it's really significant. Talk to us about your interpretation of what we got from Walmart and why it could be potentially significant, or not if you don't think so.
No, I think, anything that Walmart says is significant just because they probably have the best pulse on the American consumer out of all the retailers out there. Virtually everybody is at Walmart at some point during the year. So they have that long view that a lot of other retailers don't have. So when they signal that they're seeing some irregularities in consumer spending and a little bit of softness at the end of October, it's something to pay attention to. But I think the good news, as you mentioned, is that there's a bounce back. They said things are off to a good start in November. So hopefully it was just a glitch, but it is something to keep in the back of the mind as we head into that holiday season.
But they're smacked down by investors today. They're down more than 8% here in the trade.
Hey, another story, though, that we're following today is what happened with Macy. Shares rallying on a third quarter profit beat thanks to better inventory management, despite same-store sales falling for a third straight quarter. We just spoke about it with our friends over at Bloomberg TV, Scarlett and Katie. I want to bring in Mary Ross Gilbert, Senior Retail Analyst for Bloomberg Intelligence. She joins us on Zoom in LA. Mary, give us your take on the similarities that we saw with Macy's report today as well as Target's yesterday, because it seems like these companies are more efficient, but and investors are rewarding them for that, but there's also that concern that sales are down, that comp sales are down.
That's exactly right. I mean, comp sales for Macy's were down 6.3%. And at the Macy's label alone, it was down 6.7%. So Bloomingdale's, which really caters to a luxury consumer, was down less, in the 4.2% range. So really, and when you drill down into what's going on there, they have a little off-price concept called Backstage, with most of them operating within a Macy's stores. And those significantly outperformed the full-line business by more than 600 basis points. So it goes to show you that value is really what, and this is something that Jennifer was sort of referring when she was talking about Walmart, that value is really the king. And the other category that was doing really well for them is beauty. And they did invest in beauty this year, expanding their store space, both in the Macy's stores and in Bloomingdale's. And of course, beauty draws repeat visits, so that does help. But remember, it's, comp sales were negative. So it does show that there is weakness with the consumer.
We call it Black Friday. I don't know if it exists or it continues to be the case, but it used to be when, retailers would go into the black ahead of all of the holiday shopping that people were doing. The fourth quarter is so important to the retail community. Mary, I want to just stay with you for a moment. Is that still the case?
It's still the case. That's exactly right. Black Friday and the whole event going up to it. In fact, nowadays everything starts ahead of Black Friday. So Macy's, over the past week or so has been having pre-Black Friday sales, and I'm seeing everyday sales drop across retail for Black Friday specials out there. So promotions are really what's driving sales, and the consumer is waiting for the promotions. But yes, the vast majority of sales will occur during that period, and it is the most profitable quarter for practically all of retail.
Hey, Jen, is that the case too for even a Walmart, that fourth quarter is still so important?
Absolutely. Because especially in an environment like this where people are really watching their budgets, that's where retailers like Walmart and Target, for that matter, tend to shine. They offer great value for the money, and they offer the broad assortment. So it's more of that one-stop shopping at a good price point type of idea. And you also have to remember Walmart is the biggest retailer of food in the United States. And so we have Thanksgiving coming up. So it's not only about the general merchandise and the apparel and the toys. It's also an important quarter with regards to food. And that makes it overall really important for the retailer.
Jen, I want to go back to this idea that the first 2 weeks have looked good as a result of promotions, as a result of people doing holiday shopping. Can we extrapolate that into like the whole quarter, or is this just a one-off for Walmart?
Well, I think that there was a little bit of weakness at the end of October. What we've seen all year as we've gone through the year is that consumers spend around occasions, right? So we saw spikes around Mother's Day. We saw spikes around the 4th of July, and we saw a little bit of spending around around Halloween, but I think that consumers are picking their spots. And so this year we're expecting people to spend closer to when they need things. So people are waiting for the deals.
But honey, I need that pair of shoes. I need that pair of shoes. No, just kidding.
Go ahead. There's some of that for sure. But we are expecting that people may have pulled back in other ways to save up to be able to spend for the holiday.
Agreed.
So restaurant traffic has been down in the last couple of weeks. It may be that the average consumer is not going out to eat, and they're saving that now $60, $80 to go towards Christmas shopping.
People making choices.
They're making choices.
John, come in though, because you were,
Oh no, Jen, I thought it was interesting the earnings call with the CEO. The D word came up, right?
Deflation.
Is that right?
Well, what I can say is that we are seeing deflation in certain categories. It's not across the board, but it is good news, especially for the consumer. And the likes of Walmart, they're hoping that as food prices come down, for example, that people have a few extra dollars and that they're going to spend those dollars on general merchandise like apparel or accessories. So it is something that is coming in. It'll continue into the beginning of next year, but it's going to be a slow progression of seeing that deflation across the entire store.
So Mary, come back in, because what's interesting? I've heard people say, okay, inflation way down in the last year, but people are still paying high prices for things. But are we seeing prices increase? I mean, numbers would say they're increasing at a slower rate. What are we seeing in terms of the retailers, what they are saying about that?
That's absolutely correct. There are still increases going on, at least, if you look at the department store space. But those increases are less than what they were previously, so that does help. And of course, there are promotions. But I do want to really emphasize that this year, the level of discounting is going to be a lot less than it was last year, when most retailers were saddled with heavy inventory. And this speaks to the point that you brought up earlier, is that they've been helped by keeping their inventories low. Their inventories for the quarter were down 6% year over year. And if you compare it to pre-COVID in 2019, it's down 17%. So you can see that they've really done a good job being efficient, and then making sure that they've got the values that the consumer wants. But they're still passing on, to a certain extent, any cost increases that they're experiencing. But generally, year over year, they're much lower than a year ago.
Mary, will you repeat a statistic I heard? I was listening in on, I think it was surveillance this morning. Maybe it was with Tom and Paul, but I can't remember exactly. But is it for Macy's that 40% of their revenues comes from, is it cosmetics or fragrances during the holiday season?
Yes, it's beauty. So that includes cosmetics. It includes fragrances. Yes, 40% during the holiday period. Yes.
All right, real
And
quickly.
it's over a third for the rest of the time of the year. So they get that extra bump
Right.
during the holiday season.
I always remember a statistic years ago about department stores that in terms of like square footage, they make the most when it's like fragrances and things per square footage because it's just the markup is incredible. Real quickly, round robin, 20 seconds, Jen. Is the consumer having a hard time? Real quickly.
Consumers under pressure, but there are pockets of groups, there are parts of the consumers that are going to be spending this holiday season.
All right, good to know. Mary, how would you describe the consumer right now?
Yeah, I agree with Jen. We're seeing, overall they're under pressure. And even at the higher end of the spectrum, they're being more selective in their purchasing. But with employment still very strong, that keeps the consumer resilient.
You guys are amazing. Mary Ross Gilbert, of course, Senior Retail Analyst for our Bloomberg Intelligence team. Jen Bartashus, Senior Retail Staples and Packaged Food Analyst at BI. There's your retail roundup.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Well, the cover story of the new double issue of Bloomberg Businessweek Magazine, it's on newsstands now, on the terminal, and online at Bloomberg.com/Businessweek. It is the culmination of an 11-month investigation into a secretive London hedge fund manager who doubles as a deep-sea treasure hunter.
Sounds like fiction, but it's for real. The financier has marshaled a high-tech operation to recover lost pieces of history spanning centuries and entire civilizations from oceans around the globe. He's managed to keep this remarkable enterprise a secret until now.
For more, let's welcome in Bloomberg News senior writer Kit Chellel, who joins us on Zoom from London, and the editor of Bloomberg Businessweek, Joel Weber, here in our Bloomberg Interactive Brokers studio. Definitely check this story out online or on the terminal because the visuals are amazing, and in the magazine, it's just a fantastic story. Joel, I couldn't put this story down. It's got everything: anonymous billionaire, state-of-the-art technology, and treasure fever.
Not anonymous anymore.
Breaks? Yeah. Yes, not anonymous anymore. But tax breaks is kind of where it starts.
Kind of started there. And look, like Kit, Chellel, and company on this one, just incredible team. It does. There's so much mystery in this, and I think Kit, at his best, is like a heat-seeking missile for these mysteries like this. Everything happens underwater here, mostly. There's a few things that have ended up in courts, which I'm sure we'll talk a little bit about. There's rivalries, there's treasure, but here's the name that you'll never heard of before, Anthony Clegg, and he's a 43-year-old hedge fund executive in London. How did he get into this space, and how much does he like to get in the water? Kit.
Hi guys.
Hi.
Anthony Clegg. There's actually a bit of a history in the city of London of sort of adventurous business people, bankers, hedge fund types, going after sunken treasure in the pursuit of profits. But around the turn of the century, an ingenious asset manager came up with an idea of not only having fun looking for treasure at the bottom of the sea, pulling up Spanish coins or whatever else they could find, but they could also get a nice tax break as well with the British government. So they structured all these schemes, and that got a whole, hundreds of people in the city interested in the idea of shipwreck hunting for profit. Now, these tax schemes kind of died a death and they never really went anywhere. But it was through those initiatives that Anthony Clegg and the guys at Marshall Wace, which is a huge hedge fund, first came to the idea that they could make some money doing this.
Is it clear how much money has been made at the bottom of the ocean by these folks?
Nothing about any of this is clear. One of the things about wreck hunting is...
See what I did there, Tim?
If you're a wreck hunter, everyone wants to know what you're up to. Because basically, once you find some valuable stuff on the seafloor, it's kind of yours to do what you want with, really. So if you find it, it's top secret. You don't want anyone to know where it is. You want to be able to come back later and collect it. So they go to great lengths to kind of disguise what they're doing. So it was incredibly difficult to piece together all the different wrecks that Anthony Clegg has found. But we call him Lord of the Deep in the story. If anyone can lay claim to that title, it's him. He's found 30 or more shipwrecks the value of the stuff that he's found thousands of meters below the sea runs into billions of dollars. He's right at the very top.
Okay, but it's not like he's jumping off a ship and diving into the water to find these things. The way he's doing it is extremely technical. It's high tech. It involves some very expensive gear kit. Tell us how he does it.
Well, I kind of assumed he was a yacht guy. He's one of these people who's always out on his yacht or a sailing boat. That's not him at all. As far as I can tell, and speaking to people who've worked with him, he doesn't even really like the sea. He doesn't go out on the boats. He sees this as kind of a tech game, a data game. He sees getting to the bottom of the ocean as a technical and data challenge that he can solve better than anyone else. And so he's built this sort of swarm of undersea robots, world-beating technology, side scan, sonar. He's got artificially intelligent software. He deploys it all, and that's kind of what makes him so good at what he does.
But not every exploration kit turns out to either find something or create a lot of money for him, or returns, if you will. Or even if he finds something, right, it doesn't necessarily mean he owns it.
Yeah, it's contentious stuff, this. Governments don't really like it when rich guys with expensive boats come fishing around in their, outside their territorial waters, looking for old shipwrecks. It annoys people. You tend to attract the attention of the local Coast Guard, who come out and ask what you're doing. So Clake's guys have been arrested in a bunch of different places. Now, I should say, none of this is illegal. There's no law against, especially in international water, going and salvaging shipwrecks. But ownership is a very difficult issue. All the stuff that sinks to the bottom of the ocean ships was once owned by someone, and all those people have a potential legal claim to that cargo whenever it's pulled to the surface. So there's an expression that modern shipwreck hunting is done in the courtroom. And sometimes when you can recover $50 million worth of gold and then spend 10 years in court trying to keep it.
Okay, well, you got my attention there with gold at the bottom of the ocean. What's an example or multiple examples that you uncovered in your reporting about what kind of stuff Clake is looking for down there?
Well, he runs the gamut, really. Of course, there are 3 million shipwrecks in the ocean going back thousands of years, so there's all sorts of good stuff down there. He's found Ming vases down there. He's found like Spanish doubloons, jewelry, a more straightforward, cargo of cut silver coins from the Bombay Mint that sank in the Second World War and was just left untouched for years. You can pull those to the surface and smelt them down and sell them, and you've got, let's say, $20 million worth of silver. So there's a whole range of different things. Okay,
so no one's known this guy, but you managed to find him and get him to talk to you. What did you learn? And how did you get him to talk to you, actually?
How did I get him to talk to me? He's spent a long time avoiding scrutiny. He works really hard to keep his name out of the public domain. The kind of invisibility that he has is an act of will. He has chosen to remain in the shadows. We came to him and just basically said, look, we're writing about shipwrecks and your business. Would you like to explain sort of the complexities to us? And so we had an interesting, brief conversation where he talks me through what he's been doing over the last few years. But one thing he wasn't really able to answer, one thing I still don't really know is, why go to all this trouble? He works at a $62 billion hedge fund. He doesn't need extra money from shipwrecks. He claims not to be particularly interested in the historical side of things. So he's still kind of an enigmatic character.
You've been, though, in the Ocean Infinity control room. Is that correct?
It was one of my colleagues, Olivia, got a tour. Yes, it's an amazing high-tech facility. It looks like a sort of an e-gaming arena. There's these giant chairs and sort of Xbox-style controllers. And it's from that room they can remotely control underwater vehicles, robotic submarines. They're even building a fleet of new ships now that can be completely unmanned, that can just be at sea, controlled from their HQ.
Hey, kid, he told you that he thinks the world has reached peak shipwreck and come out the other side. Based on your reporting, do you think that's true? Do you believe him?
Is that true? I mean, look, people have been doing this for hundreds of years, and the tech is just getting better and better and better. Do I think that if one of his robot submarines uncovered a very interesting looking shipwreck that he thought might yield some interesting material, do I think he'd go for it? Yes, absolutely, I do. It's irresistible once you get interested in this stuff. Once you get hooked, it's treasure fever. You have to go back.
Okay, Kit. So, any sense of what might be on his wish list for the next treasure hunt?
That I don't know. You can play an interesting game with Ocean Infinity, which is his company. Those vessels use the AIS satellite location system, so you can actually see where they are in the world. And we played this game with a couple of ships that are chartered by Ocean Infinity or owned by Ocean Infinity. And sure enough, they were running ladder search formations in places where there are lots of shipwrecks. We don't know what they were doing. Ocean Infinity doesn't share what they do for their clients. They like to treat their client confidentiality very seriously. So they could have been there just looking for undersea cables or looking for oil and gas or something as simple as that. But
or gold.
We don't know. They could, or gold. Who knows?
Who knows?
Get the pirate's booty.
It's an unbelievable pirate's booty. Cute. Unbelievable story. Bloomberg News senior writer Kit Chellel joining us on Zoom from London. Kit, thank you so much for being here with us. And Joel Weber, of course, the editor of Bloomberg Businessweek, joining us in studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One can stand alone in the dark. Two can make the light shine through. It takes two, baby. It takes two.
It does take two. And the two leaders that were meeting in San Francisco, here's some of the commentary. We're in a competitive relationship. That was from one leader. The other saying, we'll not fight a Cold War or a hot war with anyone.
Okay.
President Biden saying the first thing about a competitive relationship. President Xi of China saying the latter, about not fighting a Cold War or a hot war with anyone.
Okay, and then there was this one. China has no intention to challenge the U.S. Or to unseat it. Again, that one coming from President Xi. And then from President Biden, he's a dictator in the sense that he's a guy who runs a country that is a communist country that's based on a form of government totally different than ours.
He said that before. So let's get to it. President Biden and President Xi spoke for 4 hours. They emerged from their first meeting in a year, betting that a handful of small victories will arrest a surge in U.S.-China tensions that has really unnerved neighboring nations and threatened global economic growth. A frequent visitor to Asia, as are members of his team. Back with us is David Riedel. He's president of Riedel Research on Zoom in San Francisco. David, really great to have you back. So timely. This meeting, significant or just a photo op, which many would also say has value in seeing these two leaders together and on U.S. soil specifically?
That's exactly right. I'm not denigrating the photo op. That's an important part of diplomacy. But I think some important things have happened here. I think a floor has been put in the relationship. I think things stopped getting worse. And I think we have the building blocks of recreating at least a functioning U.S.-China relationship, which is very important for us, for them, and for the rest of the world.
Well, point out what in the past couple of years has not been functioning and what you think, now that there is a floor in the relationship, will start functioning soon, David.
Well, the most dangerous thing is ongoing disputes in the South China Sea and in the Taiwan Straits. You may remember that China lost an international court ruling that where they lay claim to most of the South China Sea, all the way to the borders with the Philippines and Vietnam and other allies of the U.S., really saying that is essentially part of their country, and no one should pass through it without their permission. Also, the Taiwan Straits, they've determined that is what they consider an inland waterway, which is part of their country. And those are things, of course, that the U.S. strongly disagrees with, as does most of the rest of the world. And they've been conducting these Freedom of Navigation Acts, which have really rankled China. Because we've continued to sail warships through both the Straits and the South China Sea, and that's caused a lot of problems. That's actually one of the more important things that was accomplished here, the reestablishment of military communications. So I think the first thing that's hopefully off the table is some sort of miscalculation or accident or problem that results in an actual military conflict because of an accident in one of those two areas. That's something that's gone really wrong. trade policy, other things about rhetoric in both political systems have been troublesome. But really, the danger in the South China Sea and the Taiwan Strait has been my main concern.
So, like a relationship that goes bad, you can have where the two individuals don't talk, or at least they're talking, and so you get to a better way. Is that kind of where we are with the U.S. and China right now?
That's exactly right. And they're talking at every level. You know, it's important that Biden and Xi sit down, but it's also important that the high-level officials sit down, middle-level officials, people up and down the trade and commerce arena, as well as the military arena. So communication and connection at every level is critical to avoiding a problem.
Panda diplomacy.
I was going to go there, Carol.
We laugh
You're so lucky.
about the pandas leaving the U.S., been here for decades, now maybe coming back. Are we right to laugh, or that sharing of something that is native and unique to China so important and a big deal?
You know, I'm reminded of how important it was during the 1970s when we were first establishing contact with China, what they called ping pong diplomacy. And you can sort of snicker at the idea of ping pong players forming the basis of a relationship between two large, very large economies like this. But it is important to have those person-to-person connections and that sort of sentiment. Pandas are a part of the quiver of resources that China has, and I am glad for one to see them using it. But let's look for other ties between students and researchers and scientists and so on and so forth. That's what really can help. That's what helped build the original relationship and can rebuild it now.
But where are we with the panda diplomacy? Because what happened recently was China took back its pandas, and now we had Xi yesterday talking about potentially sending them back to the U.S. It seems like, I mean, was he using this for leverage that recently?
I think that the pandas are always on loan, as are art pieces and so on and so forth between different countries. So it is their right and prerogative to take them back. I'm not exactly sure what spurred that. It might have been a moment of national pride or something that led them to do that last year or just a few months ago. But the idea that he's opening back up to sending more pandas back to U.S. zoos, I think is an important next step.
Hey, David, what does the narrative or headlines get right about this relationship? What does it get wrong?
It's super complicated and very synergistic. We both need each other. We need them for a large workforce, the ability to produce things like iPhones and other pieces of technology that are in all of our pockets and on all of our desks. We absolutely need China for that. They need us to be part of the group that consumes their products and keeps their workers busy. We need them to buy our U.S. treasuries and things like that, and they need us to provide a place to put some of the reserves and the savings that they have in their country. So we need each other.
I believe it was Arshanali Basak in her conversation with Citadel's Ken Griffin this week, where he basically said, just imagine if TSMC just cuts off its supply of chips to the world. Everything shuts down. Every production line shuts down. We talk about Apple, the close connectivity between the two nations, but you think about TSMC, it just, provides chips for everybody.
And that is actually absolutely the most critical part of the U.S.-China relationship going forward, Taiwan, and what happens there. We have stuck to a one China policy where we recognize just the government in Beijing and don't have official recognition of the government in Taiwan. We don't recognize China's claim to Taiwan, but we just don't talk about that. Xi, of course, says that he wants to fold Taiwan sort of back into the motherland, as he would refer to it. And apparently during the discussions, Xi said, look, peace is all well and good, but at some point we need to move towards resolution more generally. So I don't think, this is certainly not off the table. Maybe it's not pressing this month or this year or the next couple of years. But China does have their eyes on Taiwan, and TSMC makes that a super complicated situation for the U.S. as well as the rest of the world.
Speaking of tables, there are a lot of people who shared a very important table with President Xi last night.
Well, certainly a who's who of executives there yesterday, not just at the dinner, right? Elon Musk wasn't there at the dinner. Mark Benioff wasn't there, but they did sort of a drive-by greeting during the cocktail hour. We had Sundar Pichai of Alphabet, Citi's Jane Fraser. Larry Fink was at President Xi's table. Tim Cook of Apple, of course. We didn't know, by the way, Carol, if he was actually going to be there.
We didn't think he was going to be.
Come on. He's been to China twice this year. He was there.
Of course he's going to be there.
Explain to us, the takeaways from who was there last night and who wasn't there last night, and who was at Xi's table?
Well, it is interesting that how important financial services were in that. That actually struck me, how many financial services people were there, because that's an area where U.S. banks were involved early. Some of them got burnt, but it's a growing part of the Chinese economy, and of course, a huge part of U.S. services exports into China. So that's an important balancing part of our goods deficit with China is our services. So I'd keep an eye on the financial services industry. That's pretty interesting to me. I'm not surprised that Cook was there. He knows what's important to him and his future at Apple.
It's like, I think I can move my schedule around.
Yeah, of course.
I'll make it happen. David, thank you. So appreciate it. David Riedel, president of Riedel Research on Zoom in San Francisco. Just want to quickly mention Gap out with their earnings. Looks like adjusted EPS, it's a big beat, 59 cents versus an estimate of 19 cents a share. Net sales, $3.8 billion versus an estimate of $3.61 billion. But this is the important one. Third quarter total comp sales down 2%. The estimate was for a decline of 8.66%. Stock is up 8%.
Wow.
In the after.
See if it holds tomorrow.
Yeah, exactly. They've been trying to figure, the model out. All right, you're listening to Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Fortune is out today with its world's best workplaces list. And we've got the executive vice president and chief human resources officer of the company that topped the year's list. We're going to tell you who that is in just a minute. But first, a little bit about the list. Fortune partners with the consulting firm Great Places to Work. What they do is they analyze surveys from more than 6 million employees at organizations that are certified by this consulting firm. The companies must have at least 5,000 employees, Carol. They must be global. 40% of them need to be outside of the country in which the company is headquartered.
All right. So now that we have that out of the way, we want to get to the logistics. The number one company, according to this list, is the global hospitality company Hilton. Laura Fuentes is Chief Human Resources Officer at Hilton. She joins us on Zoom from Virginia on this Thursday. Hey, Laura, it is great to have you here with us. Congratulations. So tell us, when you have a ranking like this, I'm always curious how you guys see it. What does it do for you in terms of your hiring capabilities, and what do you do with that information?
Hi, well, thank you so much for having me, Carol and Tim. Such a pleasure to be here. For us, it's an enormous moment of pride. It's been a multi-year long partnership with the Great Place to Work Institute and Fortune on this journey. And if you can imagine, we have 460,000 team members all around the world working across 20 brands in over 120 countries. And this morning was an enormous and joyful celebration around the world. So this helps us to keep our team members engaged, feeling so proud of the Hilton family, and helps us hopefully attract the next generation of leaders, of team members across our hotels and corporate office. In fact, the head of our recruiting team came up to me today and said, this is going to make our job so much easier. And it's certainly a topic we cover with candidates when they do research on Hilton and, with our team members as we look to continue to develop their careers here.
Well, talk to us a little bit about that, because the theme over the last couple of years, and we're starting to see it soften a little bit, Carol, is that companies are having a hard time attracting and retaining talent. So give us the metrics that you're seeing at Hilton and how this is a game changer for attracting that talent when people do apply and they see that this is, according to at least this survey, the best place in the world to work.
Yeah, no, look, we certainly weren't immune to some of the challenges over the last few years either. And if you think about our recruiting engines with 460,000 team members around the world, we hire over 100,000 people into our ecosystem every single year. And during COVID, that kind of came to a screeching halt. And of course, coming out of the crisis, we're back, both growing our business, hiring people into our properties, launching new brands. Travel is booming, as I'm sure you've both experienced. And so for us to be able to come back with a strong message that says all of our team members are instrumental in making an extraordinary stay for our guests, and showcasing the pride that our team members have in working at Hilton, whether that be the housekeeper, the chef, the team member at the front desk, our engineers, our tech, software developers. And so showcasing the thousands of jobs that we have at Hilton. If you think of a hotel, it's like a little city. and getting that word out that we are not only, coming back from the crisis, but coming back stronger than ever.
Laura, I do also wonder, because you guys, you have wholly owned, facilities, hotels, excuse me, and then you have those that are franchised throughout the globe. That's right. Does that make it a little bit more complicated to kind of get this done?
Yeah, I think it does make our ecosystem a little bit more complicated. And we work with our owners of our franchise properties really closely to make sure that they're building great cultures of their own with, some of our guidance on areas like recognition and learning. But of course, they're building in their own ways amazing cultures. And we're all connected with our legacy. We're a 103-year-old company. Our values are shared across the entire ecosystem, but it certainly makes it a little bit more complicated when you think about, programs and benefits that we each offer that may be a little bit different. And so we try to find the common ground. What do those 460,000 people have in common? They want to serve our guests, and they feel super proud of the Hilton brands.
I wonder about the different brands and how they're so diverse and how they're so different around the world, and how you are able to have a commonality there with the types of people that you employ, and also making sure that everybody's on the same page.
Yeah, it's a great comment, right? Our brands, if you can imagine, span from luxury, Conrad and Waldorf Astoria, to our, anchor brand Hilton, to, our full service, and then, extended stay, and some of the new brands that we're launching, such as Spark. And so we train our team members to serve our guests in the ways that they would expect at those brands, right? Where you want perhaps the deep luxury experience or the more expedited focused service experience. But again, when I travel around the world and visit all of these different properties in different countries, I'm always inspired by how the values come together, and hospitality, our teamwork, our sense of urgency, and Hilton family actually bridges those differences. So we do look to train for specific sort of business offerings. And I hope you all have that great experience when you travel with us, but we're united in that common theme of our values and our culture.
Do people who work at either Hilton corporate or people who work at different properties around the world, different brands around the world, do they jump from portfolio to portfolio company?
They do, actually. It's one of our goals, is to create more opportunities for people to move up and across categories, and from hotels to corporate and corporate to hotels. So we see that actually one of the most recent stats is that from after COVID, we saw 50% of our senior director and above roles being filled internally. And so that, to me, just is a great signal of the movement and opportunities. We try to recruit internally first. And anytime that managers are talking to the people on their team, it's really trying to open up the vast amount of opportunities that we have, not only across properties, across corporate and hotels, but also across regions. So many of our leaders have grown up as true global citizens and stayed with us. Over 40% of our team members have been with us for more than 10 years.
That's pretty.
And
that's
we've
pretty.
Experienced.
That's pretty cool.
Yeah.
That's pretty cool to have that kind of length in terms of duration at a company, and it does probably help with instilling a certain culture. Laura, one thing I do wonder, the current environment. What are you guys seeing? We had an interesting weekly jobless number, the continuing claims number, showing some softness today. What are you seeing in terms of a labor force that has been so tight? You talk about how many workers you guys hire. What are you seeing? How would you describe the labor force right now?
Yeah, I would say that a lot of the challenges that we saw 2 years ago have started to ease up. So our time to hire is faster than it was in 2019, actually. Our turnover rates, so our quit rates, as we hear spoken industry-wide, are lower than they've ever been on the corporate side, and on the hotel side are starting to stabilize. So we're seeing really encouraging signs regarding, the fact that our recruiting jobs are getting filled, that people are staying with us longer. And we just held, our annual survey, surveying all of our managed and corporate estate, and our engagement scores there were higher than ever. So we're seeing people come back to hospitality. We had lost a lot of talent during the COVID years. And I think hopefully folks are starting to see that this is an industry that has a ton of opportunity, a ton of learning, and is a lot of fun to work in.
What about wages? Is there still some wage pressure, though?
We always look at not only wages and try to stay ahead of market dynamics, but at the entire value proposition and portfolio of benefits that we offer our team members. And so we feel that we're very competitive. We offer uniquely Hilton benefits. We're always trying to stay ahead and make sure that our team members are paid a very competitive wage. And so honestly, regardless of the pressures of the market, we're constantly every year benchmarking and adjusting as we need to take care of our team members.
So is that a yes?
That's a yes.
Okay. Good stuff. Good stuff. Do you guys say recession often at the company right now? It's about 10 seconds left here, please.
We're really optimistic and very hopeful. Travel is really strong. We look at the brands that we're looking to launch next year, and we feel really, really optimistic about what the future holds for hospitality and for Hilton.
Well, so pleased to get some time with you. Laura, thank you. Laura Fuentes, Executive Vice President and Chief Human Resources Officer over at Hilton, joining us on Zoom from Virginia.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. We've got about 17 minutes left in today's trading session. Figured out math.
Yeah, that's right. 17 minutes.
I actually am really good at math.
I know you are.
Did it all the way.
I know you are. You're a math major, right?
Jeez. Well, no, but
econ.
Yeah.
Yeah.
All right. Anyway, let's talk markets. Equity side bouncing around a little bit here. Certainly a different tone from what we got yesterday. We did see yields back off. Our next guest says the tone of the market has definitely changed since those market lows back on October 27th. So great to have back with us, Michael Sheldon.
Yeah, Executive Director and Chief Investment Officer at Hightower RDM Financial Group. He's back with us on Zoom from Westport. It certainly does seem like the tone of the market has changed since those lows back on October 27th. Michael, the question is that shift in tone permanent? And are we in a new era? Or is this sort of precarious?
Well, I think the tone of the market has changed, as you mentioned, over the past few weeks. And the inflation data was better than expected. I think the Fed attitude towards the markets and what they're likely to do in terms of potentially raising rates has changed. The earnings outlook is maybe a little bit better than expected, but I think the tone of the market is likely to remain positive, probably into the end of the year. Generally, November, December are positive times for equity markets. You also had investor sentiment was very negative coming into October. So a number of things sort of moved together. The inflation data, the better than expected CPI inflation data, which was 0.2% month over month and about 4% year over year, was really the catalyst for the big move we had earlier this week. And even though we're down today, I think this trend is likely to probably generate some additional gains between now and the end of the year.
Having said that, Michael, here's an indicator of sentiment, maybe a new era, just crossing the Bloomberg terminal from ICI, the Investment Company Institute. Money market fund assets rise to a record $5.73 trillion.
Okay, well, you bring up a really good point, Carol, and excuse me for interrupting, but this is like something I've wanted to ask for a long time, Michael. If all that money is sitting right now in money market funds, it's essentially on the sidelines and it's not in the equity market. Isn't that essentially considered dry powder right now? There are all these people who have been waiting it out. Are they going to jump back in and move equity markets higher?
Well, there are a couple things going on here. One is that a lot of cash has moved into money market funds because right now you can get about a 5% yield in money market funds, which is much better than, for example, keeping your money in a bank. So money market funds, short-term rates are actually an alternative asset right now that investors can put some money in and get a competitive return. On the other hand, so much money has gone into money markets, partly because of all the uncertainty out there. And if you look back over the past couple of decades, what's interesting is money market funds have peaked around the time the short-term Fed funds rate has peaked. So if you go back and look at 2007, 2008, for example, money market funds, I think, peaked around something like $2.5 trillion. So we're much above that right now. But money market funds quickly came down when the Fed started cutting short-term rates. And then, as you said, Tim, that represented dry powder once people felt more comfortable putting money back into financial markets.
Michael, that's a great point, though. Are there other things in the market as you look at it that you say, okay, we've hit kind of peak bottom or negativity when it comes to equity sentiment?
Well, in terms of sentiment, we look at a number of things. Generally, about 80% of what we do is fundamental analysis, and probably maybe about 20% is technical analysis. So it's nice to see the technicals line up with the fundamentals. When the market bottomed earlier, just a couple of months ago, sentiment, looking at the things like the put to call ratio investors' intelligence, bulls versus bears. That was fairly negative, right? That was fairly negative. You also had a large number of stocks trading below their 250-day moving averages. So things on the technical side, things seemed a little bit stretched. And then we had the catalyst, as we talked about. We had the fact that the CPI came in better than expected. The jobs numbers were maybe a little bit less hot than expected. The dollar has come down. So those were the catalysts that we had. And in terms of things on one side or the other, earnings are one thing we're keeping a close eye on. For this year, earnings are supposed to be generally about flattish. We've had a majority of the companies already report their third quarter numbers. So far this year, right now, earnings estimates for next year remain at about positive 11% on a year-over-year basis. So that hasn't really come down. We think it probably will somewhat, but that's a positive sign for next year.
It's a lot of room to come down, right? To still be at least decent and not coming undone.
Yeah, over time, stocks tend to follow the direction of corporate profits. So it is important to keep an eye on corporate profits, even if that number comes down somewhat, which we think it likely will. Corporate profits on a year-over-year basis likely bottomed this year, and the trend does look more positive next year, even if it does come down somewhat.
So any concern from just, and not even anecdotally, but on a one-off basis, hearing from the CFO of Walmart saying he saw weakness in the last 2 weeks of the
what
October
if we go into
quarter?
A recession next
Exactly.
year?
What do you think of that, Michael?
Yeah, that's a good point. I think he surprised a few people by talking about in his conference call that he started to see a slowdown in consumer spending during the last 2 weeks of last quarter. Consumers are really important. They represent probably about 2/3 of the overall economy, and services part of the economy is more important than manufacturing. So anything that changes the outlook for the consumer definitely, is first and foremost in terms of getting our attention. Over the past few quarters, and this year in particular, I think resilient is the word that sort of describes the U.S. economy. And the reason it's been so resilient probably is because job growth has been solid. Wages are still rising at a more than 4% rate, even though they've come down. So if there are signs that the U.S. consumer is starting to slow, that could have some negative impacts for the overall stock market and the economy. And that'll be really what we're watching in the first half of next year.
You got to be quick for me, Michael. 15 seconds. New money you got to put to work. Where do you do it?
I think right now you want to be generally equal weighted in the market. You don't want to take any huge risks right now. We do think the markets are likely to trend higher. The Magnificent Seven, which have led the market this year, are probably going to see continued gains, but the valuation is more attractive in other parts of the market.
All right, good to know. Hey, listen, have a great holiday. I'm sure we'll be speaking to you again, though, before all is said and done here in 2023, but always appreciate your input. Michael Sheldon, he's Executive Director, Chief Investment Officer over at Hightower RDM Financial Group out there in Westport, Connecticut. You're listening and watching Bloomberg Radio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.